All right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here along for the ride. We want to welcome you to another exciting episode. Whether you're tuning in during your morning commute this morning or working out or just relaxing at home, we've got a great packed show for you that you're not going to want to miss. In today's episode, we're diving deep into the latest trends and movements in the financial world, and we're going to do a pretty thorough update of the U.S. stock market and Bitcoin and Ethereum in the crypto space. It's really been an eventful first quarter in the financial markets, and we're here to break it down for you. We've structured today's show into three informative segments. So first up, we're going to take a look at the stock market. We're going to discuss the latest in the S&P 500, the Nasdaq 100, the Russell 2000, and we're also not going to forget to include insights into commodities like gold and oil. It's been quite a roller coaster ride, and we're here to make sense of it all for you. And then we're going to shift gears into the digital currency space when we move into segment two. We've got a lot to talk about there with Bitcoin and Ethereum. The crypto market is constantly evolving, and we aim to provide you with insights to help you stay ahead of that market. And finally, we'll wrap things up with some closing thoughts in segment three and some reflections on the market trends that we've discussed. It's a jam-packed episode, and we're ready to get started. So without further ado, let's dive into the heart of the financial world. Buckle up, because here we go. All right, friends, welcome back to the program. My name is Jerry Robinson, your host, your guide, leading you on an excursion to truth in the financial markets, and I want to welcome you to this very first segment. We're going to be talking about the broader stock market here in the United States, and boy, howdy, has it been a historic period for the United States stock market, specifically the S&P 500 index, which is really the go-to index for the world. Is considered the best representation of the U.S. stock market. It's shown some remarkable moves lately as we look and see over the last 21 weeks. We have had 17 weekly gains. So that means that we have now enjoyed 17 weekly gains out of the last 21 weeks. That is a historic rally by all measures of the phrase. I mean, you'd have to go back to the early 1960s to see anything even remotely close to what we've witnessed here at the beginning of 2024. And we're not even through the first quarter yet. You know, the first quarter ends at the end of March. We're almost there. We're just a few days away. But it has been really quite something here in this first quarter. So what I want to do in this first segment is talk about some of these different markets and let you know what we're seeing. So we want to begin with the S&P 500. And as I mentioned, 17 weekly gains out of the last 21 weeks. That's simply incredible. Since we bottomed out on the S&P around 4,100 back in late October, we have seen this rally begin. The rally began with a nice 200-day moving average breakout on higher than normal volume back at the beginning of November. And then we have just seen a very sharp ascent. We have not even seen a pullback to the 50-day moving average, which is very unusual for a rally. Now, some people say, well, this market is overheated. Well, it's hard to argue with that, right? It very well is due for a pullback. We would like to see a pullback on the S&P to around the 5,000 level. And it may even get more of a deeper pullback. You could actually see a pullback to the 4,800 level. But all that being said, the S&P 500 is continuing to rally on strong volume. We're continuing to see participation broadly, and we've really seen the market broaden out. Right now, we have about 82% of the stocks trading on the S&P 500, trading above their 200-day moving average. And that's bullish, right? That's very bullish. And it's not really to the extreme level yet. When you get about 90% of the S&P 500 stocks trading above their 200-day moving average, at that time, you're usually due for a correction. But right now, we're still about the 82% level. So we still see there certainly could be more upside ahead before we had any kind of correction. Although, as I mentioned, we really are due for a pullback in that broad index. So again, we would not be surprised in the least to see some profit taking at some point. Now, remember, what's going on right now is that we just had the Federal Reserve meet earlier this week and announce their latest policy moves. And the policy move was to leave interest rates still. They didn't move interest rates down or up, but they did indicate that they expect 3 rate cuts this year. And after we dug into the data, it looks like we're looking at a rate cut, very first rate cut. The Fed is projecting in June. It could come earlier in May, but right now there's a 90% probability that there will not be a rate cut in May. So right now there's about a 70% probability of a rate cut in June. And then you have another 63% probability of another rate cut in September. And then about a 50% probability of a rate cut again in November. So right now we see about 3 rate cuts based upon the probabilities, based upon the Fed funds rate futures market. There could be more, there could be less. We'll just have to see what happens, of course. Right now, though, the Fed has left that current target Fed funds rate in the range of 5.25 to 5.5%. And it's those expectations of rate cuts that are really driving this market higher, coupled with better than expected corporate earnings. Corporate earnings have definitely come in better than many people were expecting this year. That's really worked out well for the U.S. stock market, the S&P just continuing to move higher. What a rally we've seen there. Now, turning to the Nasdaq 100. The Nasdaq 100 is one of my favorite markets. It's one of my trading niches and one of the places that I like to invest in for the long term. It's really a tech-heavy index focused upon, the top 100 largest non-financial companies that trade on the Nasdaq stock exchange. And when we look at it, we see similarly a very, very good rally. That market, really kind of bottomed out back in October of 2022. I'm looking at QQQ as I'm talking to you now, a chart of it, and that bottomed out around 250 or so, 254 back in October of 2022. Well, it's since rallied, fiercely. We're trading up now around $443 on QQQ, and that's the Invesco Nasdaq 100 ETF. We're trading, just slightly above the 50-day moving average and a rising 200-day moving average. The Nasdaq 100 really looking strong here. Again, we are due for a little bit of a pullback. We did get something back at the very beginning of the year and then a little bit in February, but it's just really been up and to the right for the Nasdaq 100. We like to follow that market. We like to track that market. We invest in that market. We trade that market. QQQ is the ETF that many people follow with that particular market. So we see that one rising. But again, we do expect a pullback there, just along with the other markets as well. We do think that this rally, this overall uptrend, could extend for some time. In fact, when you look historically speaking, election years tend to be good years for the stock market. And we think this year will be no different. Now, there's one other major, and it's not as major, but it's one of the leading stock market indexes here in the United States, and that is the Russell 2000. Now, that particular market really hones in and gives us a glimpse into the world of small cap stocks, which have really underperformed relative to large caps over the last many months and even years. So we do think that small caps are well positioned this year. We released our 2024 market outlook at the beginning of the year. We did a podcast to that effect earlier in the year as well, but we released the comprehensive outlook to all of our members here at followthemoney.com at the beginning of the year. And we included small caps as a market that we expected to outperform this year. They have been so beaten down, and you'll typically see small cap stocks. These are the smaller companies that don't have, as much pricing power. They don't have as much brand value. They're still kind of up and comers, many of them. But these small caps, historically tend to outperform at the end of a bear market and as a new bull market begins. Well, we've certainly seen the Russell 2000 outperform large caps to a certain extent over the last several weeks. But that has not really translated into massive outperformance. And so as we look at the Russell 2000, we're looking for more upside ahead. And the key ETF we track for this is IWM. It's the iShares Russell 2000 ETF. And right now, we just got to bounce from a key support area. We're looking for support around that $200 area, currently trading at about 208. We think the market's going to go higher this year in the Russell 2000 ETF. And so we do expect more upside ahead for small caps in addition to large caps. Now let's pivot to the commodities market. I just want to talk about a few. I want to talk about gold, silver, and oil, and maybe we'll wrap up with a look at the dollar for this segment. So let's begin with gold. Gold has had a really good run. currently trading at around just above $2,200 as of the recording of this podcast episode. So we've really seen a nice rally in physical gold. It's been driven higher again for a variety of reasons. There's all manner of reasons why gold has been rallying. I mean, you have lower real interest rates. You have expectations of falling interest rates. You have the expectation of a declining U.S. dollar. You have ongoing central bank buying. You have retail demand, which we've seen in India through their jewelry demand. We've seen investment flows into gold at their highest level in almost a year as of late. China continues to have steady demand for gold. So there's lots of reasons to expect that you're going to see higher gold prices. And that's what we do expect. We expect to see gold continue to rise, albeit not straight up we often say 2 steps forward, 1 step back. But gold now trading at above $2,200. It's just simply never been higher. It's at a record level. And that's wonderful to see for those who have been using it for portfolio insurance, as we do, because it is an asset that is supposed to protect you from the chaos, right? It's supposed to provide some sort of insulation from the ongoing debauchement of the currency and the global debt binge, that we are currently in. So gold looking good here. And we just got a really nice breakout just about, 3 or 4 weeks ago above that key 2100 level. That's a pretty big area of support now for gold, the 2100 area. And then also, I would say around the $2,000 area. That's a key area to watch on gold as well. If you look at the gold-silver ratio, I mean, it really does favor silver. Silver has just not played the catch-up trade that it typically does. When you see gold rally, you'll often see silver play catch-up afterwards, and we're waiting for that. We expect that silver is going to have its day in the sun, so to speak, but certainly we have not seen it as of late. Silver has tried and tried again to break out above that key $26 to $27 resistance level, and it's just struggled. It just hit it so many times. Going back to 2022, we saw it happen in February, and then we saw it again in May, and then we saw it again in April, May of 2023, and then again in November. And then we just got another touch of the $26 level in March of this month, March, and it just failed again. So silver really knocking at the door, but we got to see it close above $27. And then you're still going to have some overhead resistance. But, if you want it to get to 50, it's got to get through 27. So that's the key area we're watching on silver. But if you look at, a chart, for example, of the silver to the S&P 500 ratio, you just have to go back for years to see anything, this low. Silver is very, very inexpensive relative to other markets. So anyway, we do have great 2450 support on silver. That's an area we've been watching for years, and we're looking for that area to hold. And if not, well, we'll probably continue down a little further, back down to about the 200-day moving average, which is currently sitting at about 2350. Now, let's talk and move into oil. Let's talk about oil for a minute. One of the ways we track oil for our members is with the Invesco US Oil ETF, which is ticker symbol DBO. And we just saw a 200-day moving average breakout on that after it fell below that area last year. So it's retaken that area. We've certainly seen oil prices rebound as of late. We've also seen gas prices as a result, unfortunately, also rally in recent times. Now, one of the things that is driving the price of oil are the ongoing wars that we see. Of course, in the Middle East, we have this horrific war going on in Gaza, and then we also have the ongoing conflict in Eastern Europe with Ukraine. On top of that, you have a shrinking U.S. rig count. So the oil rigs here in the United States have been, we've been seeing less active oil rigs, and that's also kind of prevented oil prices from just, kind of falling. And so we do see that oil has been rebounding somewhat lately. And the two key levels that we watch for these two oil prices, we watch the West Texas Intermediate oil price. We watch the $75 level like a hawk. That's a really important level to policymakers and oil executives. And then also the Brent crude oil price, we watch for, around $85. That's a key area as well. Both of them are trading around those levels. West Texas Intermediate trading at about 81, a little higher than at $75 level we target. And then also Brent is trading at around 85. So it's right around that $85 level that we watch for. Now, we don't expect any major surge in the price of oil here, barring some sort of unseen event. We do think that oil will be somewhat range bound in these levels, that it's just kind of finding its area, or that kind of equilibrium area. But we did have Saudi Arabia and Russia did confirm with their last OPEC plus meeting that they were going to continue to extend their oil production cuts, I believe, through the end of June. So we'll continue to monitor what's going on there. Hopefully we'll see oil prices stay relatively tame. We'd hate to see them go back up too much this year. Now, finally, let's talk about the U.S. dollar before we close out this first segment. And the U.S. dollar, many people don't realize how important the U.S. dollar index is to the whole entire market. And this is something we've been teaching our members here at followthemoney.com for years, is the importance of keeping one eye on that U.S. dollar index, whether you're trading stocks or whether you're investing in commodities or whatever it is that you're doing. You want to pay attention to that U.S. dollar. And the U.S. dollar has been quite a yo-yo lately. Yeah, it did peak out last fall. Or I should say not last year. Gosh, we have to go back to 2022. The fall of 2022 is where it peaked out. We had it hit about 114, 115 on the dollar index. And then we had another kind of rally last fall that peaked out around 107. And we think that's that we're not going to see much higher prices or higher value of the index above 107. Right now we're trading about 104. So we continue to see lower highs, indicating that we do expect the U.S. dollar to begin to move down, especially as the Fed begins to unveil those rate cuts. And that will certainly cause some weakness in the dollar. We did get a little boost in the dollar recently, but that was mainly due to the Swiss National Bank. They did cut rates, and then we had other central banks in Europe indicating rate cuts. And so that creates a divergence between the interest rate policies between the Fed and some of these European central banks. So the Swiss National Bank last Thursday surprised the market with a 25 basis point rate cut down to 1.5%. And that's the first rate cut by a major European central bank. That surprised the markets, and it jolted the dollar higher, which again, can wreak havoc on the markets, especially if it's too big. Now, this was a minor rally in the dollar, but nonetheless, that kind of divergence between interest rate policies between these central banks can, move currencies pretty well. But overall, the U.S. dollar, we believe, is going to continue its downward trend. If you go back, at a multi-year chart, multi-decade chart of the U.S. dollar, you'll see that we're well below the former highs that we had hit. So we are continuing to see a long-term bearish channel in the U.S. dollar, and we expect that that's going to continue. So we expect more downside for the dollar later this year, and that we believe is going to translate into higher stock prices, higher gold prices, and even give some support to even Bitcoin prices and things like that. So a falling dollar, which we don't expect it to fall off of a cliff. We just expect it to come down steadily from where it is to a more reasonable range based upon the fact that interest rates will be falling. How fast those interest rates begin to come down will really determine, the speed at which the U.S. dollar begins to come down. So, right now people are expecting those 3 rate cuts for the Fed this year. We'll see. It could be more, could be less. We'll just find out what happens. But the dollar, of course, the value of the dollar index will be dependent upon those rate cuts. So that wraps up our very first segment here. We wanted to provide a nice update for you on the major stock market, the indices, and also a few commodities. So whether you're adjusting your portfolio or just simply staying informed, it's crucial to keep your finger on the pulse on these trends. That's what we do here at followthemoney.com. We help all of our members keep abreast of what's happening in the financial markets. All right. Well, coming up next in our next segment, we're going to dive into the digital currency space with a brief cryptocurrency update. We'll see you on the other side of this break. Stay tuned.
Welcome back to Follow the Money Weekly. here's Jerry Robinson.
All right, friends, welcome back to the show. Follow the Money Radio, where we're all about keeping you updated on the world of trading and investing. And if you've been with us from the start of today's broadcast, you know that we've just covered the stock and commodity markets here in the United States. And now it's time for just something a little bit different. Before we jump into our crypto update, I want to talk about Bitcoin and Ethereum. But before we do, we want to introduce to you, if you're new to it, our ETF and crypto leaderboard. Back in 2022, we launched what we call our ETF leaderboard and our cryptocurrency leaderboard. And these have been very popular services with our members. And I was just looking over them in preparation for today's broadcast. And what we do is we track 150 ETFs in our ETF leaderboard for our premium members here at followthemoney.com. And every week we assign them a trend ranking number and then also a momentum score. And what this is really used for is for people who want to trade ETFs or invest in ETFs that might be beaten down, because what's really interesting about these services is that you can sort them by ranking. So you can sort them from, number 1 to number 150 in the case of the ETFs, or you can sort them the opposite way and find those ETFs that are really beaten down. So let me just share with you some of the top ranked ETFs this week. As we look at the ETF leaderboard, we have things like the financial sector ETF, XLF. That's the number 1 trend ranked ETF. And then we have the S&P Insurance ETF, ticker symbol KIE, coming in at number 2. The Wisdom Tree Japan Hedged Equity ETF, DXJ, ticker symbol, coming in at number 3. And then we have the S&P Home Builders ETF, XHB, number 4. We have the industrial sector here in the S&P 500, XLI. We have Italy and Peru and agriculture, DBA, ticker symbol, all rounding out that top 10. And then if you sort them by the opposite, if you actually want to see the weakest performing ETFs, you have names like China Healthcare, or the Japanese yen, or the agricultural product corn, or even rare earths and soybeans and the Swiss franc. These are some of the ETFs that are really beaten down right now. What our members do is they will use this weekly updated leaderboard to be able to identify new trending markets. We also provide new uptrend alerts on these ETFs as well. And so it's a really powerful service. And then we also have our crypto leaderboard, which basically does the same thing. We track just under 60 different cryptocurrencies, and we rank them according to their trend strength. And so it's been a really powerful way for our members to stay on top of the markets, whether they're looking for the leaders or whether they're looking for the laggards. Then these services are really great. So anyway, if you're a member here at followthemoney.com, just navigate to your dashboard and check out the ETF leaderboard and the crypto leaderboard and learn more about them there. And if you're not currently a member, we encourage you to become a member here at Follow the Money. You can go to our website, followthemoney.com/join, and choose the plan that's right for you and get access to our very cool and innovative trading and investing resources and services. We have many courses as well for our members. There's lots to see. So anyway, we're incredibly proud of all of the services that we have here. We work very hard on them, and so I like to highlight those occasionally. Now, on to the world of cryptocurrencies. It's been a roller coaster ride for digital currencies over the last few weeks. There's no denying the impact that they have had on the financial landscape, both here in the United States and globally. And today I want to zone in on the titans of the crypto world. We're not going to go through every cryptocurrency, of course, but we're going to focus on the top 2, Bitcoin and Ethereum. Bitcoin, will begin there, the original cryptocurrency, the world's largest and most liquid digital currency that continues to lead the market. And of course, the halving for Bitcoin is coming up in around 3 weeks, right? I think the expected date is April 20th. We actually did a show on the topic of the halving just a few weeks ago. In fact, you can go and look at episode number 457, which is entitled The Bitcoin Halving Effect. And there we talked quite a bit about what the halving is, why it's important, and what it often means for the price of Bitcoin. We also did an episode 454, The Crypto Revolution, where we talked quite a bit about the new Bitcoin ETF and a lot of the things related to crypto. Today, we're just going to do some analysis of the current price of Bitcoin and Ethereum and just provide some of our insights. So right now, if you're looking at Bitcoin, many of our members, of course, here at Follow the Money are long Bitcoin. Many of our listeners have known about Bitcoin for over a decade. We've been talking about Bitcoin right here on this broadcast for years and years and years, going all the way back to 2013 or so. Now, Bitcoin, as you well know, had a really nice rally since it broke out from its 200-day moving average back in mid-October. And that was when the price was hanging at around like 27,000 or so. We got a nice breakout back in October and especially in November, and then we just continued to run. And we recently touched a brand new all-time high earlier in the month of March of around 73,750. That was the peak. And that took out the former peak of 69,000, which was reached back in late 2021. So it's been quite a ride here for Bitcoin investors. Now, we recently saw, after this very breathless rally that began toward the beginning of February, we had kind of a nice breakout in late October, and then we had a nice rally, and then we meandered for a little bit throughout the month of January with the ETF approval from the SEC. And then we took off again in the beginning of February, and that was a pretty breathless rally that took us all the way up to that brand new all-time high of 73,750. Well, we got a bit overextended, technically speaking, on Bitcoin, and it was due for a pullback. And sure enough, we did. We got a pullback to around the $60,000 level. In fact, it was a little bit above $60,000. Now, we had told our members to watch out for the $59,000 support level on Bitcoin. We expected it could come back down to about 59. We got down to 60 or so. And since then, the market has rebounded and gone back up to that $70,000 level, but it's still kind of churning below its former high. So just to basically say this, that if you're watching Bitcoin, you're following that particular cryptocurrency, you invest in it for the long term like we do, and you're just kind of curious about price levels and what to expect, well, we think that we are due for a pullback to the 50-day moving average, which again is right now right around 60,000. We didn't actually touch it when we pulled back recently because the 50-day moving average was still well below that. But now, over the last few days, we've seen the 50 kind of catch up, and it's about 60,000. So it definitely a pullback there would be totally normal. I mean, completely normal to see that. But we could see a further pullback possibly if the market begins to sag and begins to pull back again from the current $70,000 price that it's at now, then you could see a pullback to near all the way the $50,000 level. We don't envision a pullback beyond that. Those are the two key pullback areas we'd be watching, 59,000 and 50,000. We continue to, as you well know, as we've talked many times on this broadcast, we continue to dollar cost average into Bitcoin, believing that it has much more upside ahead as we move into 2024 and into 2025. We do expect a lot more upside for Bitcoin. It's obviously not as cheap as it was back, say, in 2022 when we were dollar cost averaging when it was around, 15 or 20,000. But now it's, up to near a new all-time high. And, it could continue powering higher. And we think that there's going to be a lot more room to the upside for Bitcoin as we move forward, and especially with that halving just around 3 weeks away. And again, I want to stress to you, if you're not familiar with the halving, be sure to go back and listen to episode 457, the Bitcoin halving effect, where we really break it down, explaining the mining, the economics, what we would call the tokenomics of Bitcoin. We explain why we think it's going to go higher. And we also explain how we like to invest in that space, including, our allocation and also how we like to store Bitcoin and all of that. So I encourage you to check that out when you have time. But suffice it to say that we do expect Bitcoin to continue rallying. We expect it to continue moving higher this year, albeit, again, not straight up. No market just goes straight up forever. So we would expect some pullbacks along the way. The two key areas being 50,000 and 59,000 for key support areas. Now, the second cryptocurrency that we wanted to talk about in today's update is Ethereum. And it's not just playing second fiddle to Bitcoin. It's an innovative smart contract platform And it's become a cornerstone of decentralized finance, also known as DeFi. It's become a cornerstone of the NFT movement. And Ethereum just has, in our opinion, quite a bit of potential upside, even from where it currently is. So as we record this broadcast, Ethereum is sitting right around the $3,500 level. Now, it also had a very breathless rally from around 2,300 or so at the beginning of February, all the way up to a well above 4,000. It was like 4,100 before it ran into resistance. Well, Ethereum did pull back to its 50-day moving average and bounced from it. That was in the third week of March. No, it was not too long ago. And now we've seen it rebound from that level. So Ethereum is trying to continue its upward movement, and there's a lot going on for Ethereum. One of the key things that's Ethereum right now is facing is the fact that the U.S. Congress is demanding that the SEC, the Securities and Exchange Commission, explain if Ethereum is a security, right? And the debate over Ethereum's security status has been lingering for a long time. It's been simmering. So many other countries, friends, have already dealt with this. They've already created tax laws around cryptocurrencies that are not opaque, not even translucent. They're very transparent. They've already created, guidelines for what a security is and what it's not when it comes to cryptocurrencies. Many other countries have got way ahead of this. The United States is not one of them. The United States has been dragging its feet on this topic, and there's obvious reasons why, right? A, they don't like transparency, right? They don't want transparent. When you put things on the blockchain like Bitcoin, it's completely transparent. So you can see, everything that goes on. That's not, transparency is not a friend to empire, and so Bitcoin and Ethereum and all of this is a little bit, and on top of that, this is very innovative technology. And there's a lot of financial players that want to get ahead of this, and they kind of drug their knuckles on it. So now, in some ways, the good old boy club in Washington is, I think, probably playing a little bit of safety for the big financial institutions, the traditional financial institutions, the big legacy players, to allow them to catch up here and get ahead, if at all possible, of what's coming. And so there's a lot of debate around Ethereum, and it does carry more risk, I think, than Bitcoin, which already carries its own kind of risk. And the way you manage risk in the cryptocurrency space, from our opinion, is that you just limit your allocation. Some people say, well, I won't touch it. Well, I understand that. Others say, well, I'm going to go all in. Well, I don't understand that. I think you do need to have a prudent allocation to it if you're going to be invested in this space, and it needs to be, moderate and maybe even conservative, especially as we're learning more and more about this space. But Ethereum looking very good, recently bouncing from that 50-day moving average. Still lots of concerns about, what Ethereum really is. Is it a security? But we're of the opinion that Wall Street is going to like Ethereum even more than they like Bitcoin. And we know Wall Street likes Bitcoin. Take a look at the Bitcoin ETF inflows, the spot Bitcoin ETF inflows. They have been incredible, right? So we know that and we've talked about that on previous episodes. So we know that there's a big demand for Bitcoin from the retail investor and from the institutional investor, as we've already seen. Well, the reason why we think Ethereum is going to be more attractive to Wall Street is because Ethereum pays what we would call in Wall Street terms a yield. That is, it yields based upon staking. So when you take Ethereum and you stake it, well, you end up earning something like a dividend in the world of stocks, where it's called a staking reward. And if Wall Street likes anything, it likes cash flow. It likes a dividend, right? And so Ethereum pays a theoretical dividend, if you will, for when you hold it and stake it and secure the network. And so Bitcoin is different in its protocol. So it relies upon a proof of work protocol where miners get the reward for securing the network. But in Ethereum, the way that the network is secured is through staking, and that is where you lock up the Ethereum, and it's not moved. And when you do that, you receive the reward. So stakers are rewarded in the proof of stake protocol that Ethereum uses, whereas miners are the ones who get the reward in the Bitcoin protocol. So all that being equal, we see, Wall Street is very likely to enjoy Ethereum and its yield, its staking yield, even more than it likes Bitcoin. So we are bullish on Ethereum. We own both of these cryptocurrencies with a long-term hold. We're basically holding them for the long term. We do expect both of them to continue doing well into 2024, albeit with some pullbacks along the way. And we expect that we will even see even greater gains in 2025. At some point, according to the 4-year cycle in 2025, the party will come to an end. And then we'll begin to see a downdraft and move back into what we would call a downtrend, and then probably a lingering crypto winter, at which time, the prices will consolidate. Some of the projects that were overhyped will fail and things like that, some of the smaller altcoins. And then we'll move back into another bull market cycle with the next halving. So, it's an exciting space. It's an innovative space, but at the same time, it takes a lot of research, and you don't want to over leverage yourself in cryptocurrencies. You want to be cautious in that space and do a lot of due diligence. But we think it'll reward those who take the risk with a prudent allocation as we head into the remainder of this year and into 2025. All right, friends, and just like that, we've arrived at the final segment of today's episode. It's been a good journey. We've been through the ups and downs of the stock market, the world of commodities, and the ever volatile and yet fascinating realm of cryptocurrencies. And we've covered a lot of ground today, from the latest trends in the S&P 500, the Nasdaq 100, to the ongoing developments of Bitcoin and Ethereum. And before we part ways today, I'd like to leave you with some closing thoughts. Investing, whether it's in traditional stocks or in cutting-edge cryptocurrencies, it's as much about understanding the market as it is about understanding yourself. It's about navigating through optimism and pessimism, through booms and busts, and keeping a clear head with a grounded perspective. And that brings us to our final word for today, a powerful quote from Benjamin Graham, who is known as the father of value investing, when he wrote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." I really like that quote because it really embodies the essence of strategic investing. It reminds us that success in the financial markets is not about chasing highs or running away from lows, but it's about being informed and staying patient and making decisions based upon rational analysis and not based upon fleeting emotions. And that's just something to think about. As we wrap up today's episode, I sure hope we provided you with insights that enlighten and inform and inspire you. The world of finance and trading and investing is vast and complex. It's also full of opportunities for those who are willing to learn, who are coachable, and who can adapt. Whether you're making your first investment or you're looking to diversify your portfolio, remember that knowledge is your most valuable asset. Thanks again for joining us on Follow the Money Radio. It's been a pleasure to share this time with you. Look forward to our next journey together. Don't forget to subscribe to our podcast. Follow us through our social media channels as well, and share your thoughts and questions with us. We love hearing from you, and your feedback helps us make each episode even better. So until next time, stay informed, stay curious, keep investing wisely, and remember, when you want the truth, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Till then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial